Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Welcome. Thanks for being here today. Fellow traders, cycles analysts, or students of cycles. I have a very sobering but pragmatic talk for you today. The sobering part of it is this. The most important thing we have, the most important thing we have ever had, the most important thing we will ever have is time. It's the only thing, obviously, that we can't buy more of. Maybe with a lot of money we could buy a little more time, but no one's getting out of this alive. The older I get, the more that becomes evident, although it should have been evident from the very beginning. So today, what I want to do is talk to you about the pragmatics of time, because whether we use cycles or traditional technical analysis, the bottom line is this. Sooner or later, most likely sooner, you have to make decisions. You have to choose. If you generate 40 possible trades a month, or you look at 39 different cycles, sooner or later you have to decide which one you want to trade, or invest in, or analyze, or study, or otherwise. How you make that decision is very important, because that decision will either lead you down the rabbit hole and waste your time, or it will bring you success if you made the decision the right way. Ultimately, there is no right way or wrong way. The way that you choose is your way. But if you know there are other choices, other ways in which you can make decisions that are efficient, productive, for whatever your goal may be, whether your goal is to make money, to stop losing money, or simply to enjoy the academic pursuit of looking at a cycle and saying, wow, that is cool. Whatever it is, there's a faster way to get there, in most cases, than the way that you've been using, unless you've studied it and traded it and done it intensely as I have. So what I offer you today comes from a place of kindness, a place of respect for your opinion and for your experiences. But mostly I just want to share with you what I've discovered, which may be in and of itself not very astounding, certainly very obvious, but sometimes things need to be right in front of our face, hiding in plain view before we see them. Let me give you some cogent examples. I have studied under many teachers when I was younger, and I've trained many students to trade successfully, literally hundreds of them. I have learned more about traders than I have learned about trading. I've learned more from my students than I've taught them, because I see patterns in their behavior, patterns that are broad-reaching, that cover all individuals, no matter what country they're from, no matter how old they may be, no matter what sexual persuasion they may be. The fact is, they all share certain things in common, and I've learned from those things, not just as an enjoyable experience of learning, but also to help me with my own struggles that I had when I was a trader and started many years ago. As an example, I had one student who regularly analyzed the markets, by which I mean every day, and at the end of the day he would come up with 30 or 40 different possible trades for the next day. He had serious trouble determining which trade to take. Have you ever been in a situation? You have 5 or 6 choices to make, and most of the time you pick the wrong one. You pick the one that lost money, or you pick the one that made less money, or you pick the one that didn't go anywhere, and you sit there and you say, what did I do wrong? My approach was good, my timing was good, my understanding was good, my risk was good, my attitude was good, my discipline was good, but I picked the wrong goddamn one. How am I going to change that? Well, I eventually defaulted to my way, which I will help you with today. But for one of my students, he sat there for hours after making his choice. After making his choices, he had 20 or 30 choices, as I said before, and he would sit there sometimes for 2 or 3 hours trying to determine which one he should take. Invariably, he took the wrong one. So I said to him one day, "How do you make your choices?" He said, "It's easy. I go through the charts. I look at each chart visually. I pick all the ones that are at the bottom of the chart." I said, "What do you mean, the bottom of the chart?" He said, "Well, you notice how this chart moves from the lower left to the upper right? That's an uptrend. And this chart moves from the upper left to the lower right. That's a downtrend. I picked the ones that are at the bottom of the chart, the ones that have been in a downtrend." "And why do you do that?" He said, very innocently, "Because I figure they're at the bottom of the chart. They can't go much lower." Wait a minute, wait a minute. You're telling me that because this stock has gone to the bottom of the chart, it can't go any lower? He says, "Well, yeah, that's right. Otherwise, it wouldn't be at the bottom of the chart." I said, "Well, let's do this. Let's rescale this chart." I rescaled the chart, and suddenly the data that was at the bottom of the chart was in the middle of the chart. He said, "How did you do that?" I said, "Well, that was pretty easy to do. I simply ran a new scale." That opened a whole new world of understanding for him. I realize it may sound rather simple, but it is one of those things that happen in life. You just sit back and you say, "You can't believe it. You just can't believe it." But it's true. There are many things like this. So, for example, as you may know from having attended my sessions in the last few months, at the beginning of the year, at the end of last year, at the beginning of this year, one of my big choices for a bull market was stocks. I decided I would not sell short any stocks because the bullish indications and indicators that I looked at were so bullish. I knew that selling stocks short would be a losing proposition or would be a low probability proposition. Therefore, during 2025, I have not sold short a single stock, and I've been very reticent to let winning trades go easily as opposed to keeping them for a longer time because I knew the trend was up and still is up as of today. In addition to that, I was strongly convinced that the Japanese yen, given its very accurate 7 to 8 year cycle, would go higher against the US dollar, but I never got a trigger to buy the yen, and therefore, here at the end of 2025, I'm still waiting. I thought that gold would go higher. Indeed, gold had a beautiful cycle. It was translated to the right. I knew it would top late. I have not been short a single share or contract of gold for the entire year. In fact, I just cashed out of a bunch of silver just the other day based on the cycles and the seasonals. So my conviction was to go with the major trend, to go with the cycles. But over the years, I've discovered that that is really not the right approach for me. The right approach for me is always to default to the lowest risk. I'm going to say this very clearly and slowly. I always default to the lowest risk because in the bottom line, I'm really not a trader. I'm a risk manager. So by defining my job as that of a risk manager, it means I'm always trying to limit risk. As an example, yesterday, there was a much, much higher gap opening in S&P futures. That gap higher opening limited the possibility of how much money I could make based on an intraday pattern. I opted not to take the pattern. And even though the pattern turned out to be correct and made a few $100s per contract, I was not in that trade because I made the decision immediately upon the opening that the risk was too high for me and it was not worth me chasing after a few $100s, risking a few $1,000s per contract. I defaulted to risk, to the lowest risk. I believe that defaulting to the lowest risk possibility when you're faced with a number of decisions is the best thing for most traders because after all, we are, in fact, risk managers And if we run out of capital by not managing risk correctly, the game is over until we refund our accounts. I want you to think about that. Let me give you an example of what I'm talking about. But before I do that, please remember this. I believe, not to be contrary to anybody else, I believe that it is not worth my time to analyze every possible cycle. I don't want to use the cycle to analyzing tool that causes me to look at 11 different cycles and combine them and reach a conclusion. I don't have faith in that process for myself, but for other traders who know how to use that, traders who've developed that beautiful approach like Richard and Lars, they can understand it. They can make it work for them. It's the right thing for them. But for me, that does not help me manage risk because I don't know how much risk is associated with that process. If I understood the process better, I might reach a different conclusion. So when it comes to cycles and timing, it's every person for themselves in terms of how's the risk. If I had an unlimited supply of cash, like Elon Musk or Warren Buffett, risk would not be my favorite default. Risk would be somewhere in the distance. I'll be going for maximum profit or some other degree of satisfaction that can't be measured. But let me give you a more concrete example because I realize talking theory is one thing, but talking reality is another. As you know, if you've been coming to these meetings, I like to look at the seasonal charts that show the DNA of the market, for lack of a better term. I'm going to go to seasonal charts, like so. I'm going to go to US stock charts, like so. Bring them up and show you a chart that you've seen many times before, but I want to explain it to you clearly. I'm going to go down here to S&P. So I'm looking at this chart, S&P, S&P Composite, 1960 to 2025. I've explained it many times, but let me do that again. This chart is an adjusted seasonal composite chart, detrended. What I've done is mathematically, and believe me, I'm no mathematician, anybody can do this. Mathematically, I've taken every year of this stock S&P 500 from 1960 to 2025, and I've extracted the individual yearly trend from the overall trend. In other words, I've normalized the data. I made each high of the year, of every year, equal to 100, and made the low equal to 0, so that I have here what I call a pure DNA seasonal pattern for this stock. It basically says that we begin the year at the lowest point of the year, we end the year at the highest point of the year. And remember, not every year will look like this, but most years will tend to look like this. Looking at this chart, I can see very clearly one of the most predictably bullish times of the year has been October, November, and December. So that is my first major decision. It tells me that this is a period during which my exposure, my risk is lower because my potential of going up is higher, is stronger. I could say the same thing right over here for this 2-week period of time in February, or for this 2-week period of time at the end of August, but right over here. But these would be very short term and may be favorable for some traders, may be favorable even for me with a large enough position, but generally speaking, I would not be looking at something like that. However, October, November, December, which is characterized by a predominance of arrows up, each arrow meaning high probability statistically of going higher. So we can see that within this period of time, October, November, December, there are numerous up arrows, all suggesting that this has been historically a good time of the year to be long the market. So this means to me, my risk is lower and I want to be an active trader from the long side during this period of time. And I want to avoid short positions because they would entail more risk for me. But let's take that segment of time that we're looking at right now, October, November, December. Within the month of October, there are many choices. Within the month of November, there are many choices. Within the month of December, there are many choices. In fact, between October, November, and December, if we go down to the detail, show me exactly when to get in. Show me exactly when to get out. There are literally hundreds of choices. How am I going to make the choice that's right? And I'm not talking about right in terms of the most accurate. I'm talking about the right in terms of the least risk. Because remember what I said. And although I say it again and repeat myself, I always default to risk. I may allow high potential profit or accuracy to attract me, to make me sidestep my strategy. But in the bottom line, I'm going to default to risk. I'm going to show you exactly how to do that. I'm going to go back to here. Just one moment, please. And go to seasonal trades, US futures trades. I'm going to go to S&P, which is what we were just looking at. I'm going to ask a question. Remember, the questions you ask are going to determine the answers you get. Let me share with you a little experience, by the way. I've lost some confidence, a lot of confidence in artificial intelligence. A few weeks ago, I went to one of the AI engines and asked the question, how many books has Jake Bernstein written? What were the titles of those books? And can you give me a summary of what the subject matter was for each book? The computer came back to me very quickly and said I had written 3 books. In actuality, I had written 40 books or more. And then it gave me the names of books that I not only never heard of before, but books that were written by Jake Bernstein. Well, it comes to happen that there's more than one Jake Bernstein. I go by Jake or Jacob. The other Jake Bernstein goes only by Jake Bernstein. He's a political writer in Dallas and has written some very famous books. And yet, I was not informed about this by the AI until I asked many, many questions. The reason I say this is because I'm sure that over time, AI will learn to do better. But I've asked it some other questions and it's failed miserably. So we need to be really careful what we believe, even going forward, when we see how AI does. Be very suspicious of what you hear because it may be not just wrong, but dead wrong. And I'm very concerned about what that might mean. So I'm going to go to S&P. I'm going to go to the month of October. I'm going to ask and by the way, you should be able to do this on any valid, worthwhile seasonal software. You should be able to get answers to these questions in the same way that I do. I'm going to say to the computer, go to your database for the S&P 500 in the month of October and find me trades that have been right at least 75% of the time, by which I mean from the entry date to the exit date, the accuracy has been 75%, meaning that on the exit date, 75% of the time or more, the S&P 500 was higher than it was on the entry date, and that it never declined more than 5% from the entry. So I'm going to risk 5% here, like so. Just bear with me, please. I'm going to ask it to give me short-term trades because this is a very bullish period of time. So give me trades that have been duration 25 days or less. Now, this configuration is one that I choose. You can choose anything you want. You should be able to choose anything you want. I choose this combination because I know that for me, being in a trade for more than 25 days is difficult to do unless I'm trading my 401k as an investment. But as a futures market or a short-term stock trade, the time is limited in terms of my patience. So this is my combination. And so I'm asking the computer, find me everything in S&P 500 futures that fills this requirement. And I do a search. By the way, what I'm telling you comes straight from the heart. None of this has been rehearsed or scripted. This is strictly ad lib, which is why I'm doing such a bad job at it properly. So let's go. We're going to do a search now. And the computer gives me 8 pages of possibilities. That's right, 8 pages. So now you can see what I mean when I say I have many choices. So the incumbent question now is this: what to do? The computer has been programmed to organize these trades based on highest probability of success. So as you can see right here, it has taken this trade here with 89% accuracy, placed it at the top of the list. The next one down is 80, is also an 89%. As you can see, they get lower and lower as you go down the list. The question is, as I said before, is this the lowest risk trade I can take? Well, first, let's evaluate the trade and see if it's definitely doing what the computer says it's doing. It says buying S&P futures historically, end of day, October 27th, or the next business day if the market is closed end of day. Getting out November the 6th has been correct 89% of the time. For many years, we're going to look at how many momentarily, risking 3% stop. So I already know that I'm risking less than I want to, than I had intended to risk, which is good, but I want more. I'm going to go to the history like so and look at the history. What does the history tell me? It tells me it's been a beautiful trade, and over the last 28 years, it has been right 89% of the time. And look at that, the bottom of the screen. 2 years ago, it turned in its best performance ever, even though this is a trade that has been known by practically everybody on the inside of the trading community. So it immediately says to me, it doesn't matter how many people know of something. What matters is what they do. And knowing something is going to happen or likely to happen is not a guarantee that it will happen. But I like what I see, and I go down a little lower and I like the performance graph because it's been very stable. And here it is moving from the lower left to the upper right. Typical bullish trend. But I'm going to look a little further. It says that in order for me to take this trade, the average losing trade has been 27 points. 27 points in S&P times $500 a point is a substantial amount of money for any trader. And if you're trading multiple contracts as I do, it's even more. So what are my choices? Choice number 1, decrease the position size. Choice number 2, decrease the contract size to a mini or micro contract. Choice number 3, take a different trade where the risk in dollars is lower. But I know that if I trade lower risk dollars, it's going to decrease my accuracy. So I'm faced with a choice. Am I willing to give up the accuracy of 89% in favor of lowering risk? My answer, based on considerable experience, is almost always going to be yes. I'm happy to trade for less accuracy with lower risk than I am for higher risk with higher accuracy. That's just my way of doing things, my way because I learned it the hard way, and you can do anything you want, of course. But let me show you some differences and similarities. I'm going to go back to the history. I'm going to return to the search. Now I'm going to keep it right over here and say, let me sort this spreadsheet. I'm going to go to average loss. I'm going to choose the lowest average loss by resorting. Let me show you what I mean. I've now resorted for the lowest average loss. The average loss here is 10 points, which is a lot smaller than the previous one. We've sacrificed some accuracy to the tune of 7% accuracy. So even though we're 82% accurate, which is still a highly respectable number, we've decreased our exposure and therefore this trade is the better trade for me personally. But I want to look at some history. So let's do that. Here's the history. Again, 28 years. And let's look and see how consistent it is. So here's the consistency. Notice the performance graph still reads positive from the lower left to the upper right. And back here, it's had one losing year, but it's surrounded by many winning years, especially large ones. So in this case, not only have I lowered my exposure, but I've also found what I think is a better trade without sacrificing too much in the way of profit. Let me show you something else that you might be interested in. Again, I realize that most people want to trade for accuracy and dollars profit, but if you want to be survivor in these difficult markets, you will default to lower risk. Take my advice. Let's go back here and let's return to the search. Let's do the same thing, except this time, let's do it for the month of November, because here we are almost in November. I'm going to keep my same parameters and see what happens. And by the way, I hope this is turning out to be an educational experience for you, because that is indeed my goal. No one is paying me to do this. I'm not paying anyone to do this. I want to make sure that I leave a legacy of accuracy that will help you be more successful. Here's November, and do the search. And we have got, wow, 21 pages. And overall, it puts the so-called best trade in the top position. This time, November 2nd to November 6th, both short-term trades. I'm going to default not to lowest risk, like so. Percent, let's see, average loss right over here. And resort. And my lowest risk would be 11, which is more acceptable. But the dates have changed dramatically. November 25th, 20th to December the 7th. But let's look at the history again. And remember, I've lowered my risk, but I've given up a lot in percentage accuracy. No problem. I'm okay with that because I know how this works in the long run. If I'm managing risk and preserving capital, that's what it's all about. So let's go to the history, like so. Here's the history, 28 years. And let's go down this way here. Not really very dramatic, but certainly respectable. And having put in its third or second best year last year, right over here. So that's the process. Let's do one more before my voice runs out. Let me give you a trade for December. And by the way, we're going to come back if I'm still available in terms of time and longevity. We're going to come back in December and take a look at the trade. And we're going to do December now. Remember, these are not specific recommendations for me to manage your money. They're for you to look at and consider the possibilities within the scope of the fact that we know there's risk involved in trading, etc., etc., etc. And here's the search right here. So, and again, another 82%er. December 11th through January the 1st or 2nd. Let's sort for average loss. Very reasonable average loss of 6 points. And here's the history. 75% accuracy, which is fine with me. There's the trade. Quite a dramatic performance since 2017, 2018. One outstanding winning year over here. And all the rest of the statistics are good. So this will be my trade for December. Remember, any of these trades can be traded as an option. So if you're buying a call, you're limiting your risk to the price of the call. And that's all there is to it. So let me summarize for you before I run out of gas entirely. Time is the most important thing you have. You need to limit your time available you need to limit the amount of risk that you take by limiting the amount of time that you're in a position, but also by limiting the amount of risk. So the bottom line is, I'm a risk manager. Consider what I said to you and see if it fits on your program. Go back and look at some of your losing trades, especially your large losers, and see how they might have fared in terms of your overall performance, risking less amounts. Again, I want to stress, some people are very good at combining cycles and looking at all the relevant cycles for a particular trade. I'm not one of those people. I'm very focused on a specific seasonal pattern, a specific cycle, which brings me my best results. If I can clarify anything I've said here to you today, you can write me at the foundation, or you can write me at my website, jakebernstein.com, and I'll be glad to help you out. Thank you very much, Foundation, for letting me do this. And I'm sorry the voice is starting to fade, but I think I made my points. Best of trading to everyone and a happy new year if you don't hear from me again until later on.